Forex Focus brought to you by IG. Today, taking a look at the 10 best chart indicators for trading. And of course, none of these indicators solve trading necessarily. This isn't a scenario of, oh, if you download this one and apply it to your chart, it's going to tell you what to do. These are all meant to supplement your trading. And today we're just highlighting 10 of the best ones as measured by, their use by traders over the course of the last several years. You'll see that these are indicators that are, one, easy for the new trader, but also existing trader to grasp conceptually. Two, easy for them to implement in their platform. And then three, helpful to them forming an idea, because at the end of the day, the trader decides on whether to go long or short in whatever market. But the indicator is a mathematical calculation that supplements charting and helps traders a lot of times to decide on their positioning. I hear so much from, friends and different people who are in the industry who trade, and almost everybody says, oh yeah, I use the moving average, or I use Bollinger Bands, I use this and that. But almost all of them have this more strategy of, I use it to help me confirm my opinion, or to help, go against my opinion and talk me out of a trade that I had already in my mind from just either looking at the chart or looking at the fundamental analysis or what have you. And so, yeah, these indicators that can be provided from a place like IG, and here you have just some moving averages on the very popular Forex pair, Euro versus USD. You lay them on top of the chart, you learn a little bit about them, and they can, when they're showing something that is, notable, a lot of times these indicators will, more often than not, they'll be in what I would call like a normal mode, where they're not really showing you anything. But when they do show you something that is notable, then you go in, you take a look at it. Is this worthwhile for me to take advantage of? Is this something that jives with my strategy? And you go from there. But here are those top 10 chart indicators: moving average, exponential moving average convergence, divergence. And as you can see, they're in the top three, all being around moving averages. Those are indicators that have been around for so long. The moving average, the simple moving average, has been around for so long and has been so helpful for traders since the start of screen trading decades ago. Also very popular, you have the Stochastic Oscillator, the Bollinger Bands, Relative Strength Index, and then Fibonacci retracements. A little different than your normal chart indicator, but has really gained a lot of traction over the course of the last couple of years. I hear so many more people talking about Fibonacci's in the last 5 years than the 5 years preceding that. Standard deviation is an essential piece to so many different parts of trading. We'll cover that. Ichimoku is more of a new indicator and is maybe considered more of a hipster type indicator, not in mainstream use so much, but maybe you'll think that piece is interesting. And then finally, client sentiment, or a lot of people will refer to that as there's the commitment of traders report as well, essentially where people in a given market are positioned long or short as well. That's provided by IG. The simple moving average is going to be differing time windows of an average calculation, which is to say here in this example, there's a 20-day, a 50-day, and a 100-day moving average. And one, you can use any of these moving averages to say, oh, okay, well, if the price right now is around the 50-day moving average and is kind of moving below it, then maybe that's a support line and it will bounce back above. And same to the flip side, you can use them for support and resistance in that way. But a lot of people will use them to look for crosses, which is to say, when a short-term moving average crosses a long-term moving average, that is a potentially notable signal that that market might be either continuing in that direction or reversing off of such a noteworthy signal, so to speak. And that depends on whether you're a trend follower or contrarian. A trend follower might see, a 20-day moving average moving below a 100-day moving average and say, oh, this is a reason for this market to move even lower, to continue that trend. Whereas a contrarian might see that, wait for it to move a little bit lower, and then think it's going to reverse and go against that potential trend there. Exponential moving averages, very similar concept, but they do give more weight to recent data points. And again, you can use them for support, resistance, crossovers, and everything else. Very similar in there. And then the moving average convergence divergence uses moving averages of different time frames, and it kind of adds an extra layer signaling for this market to either be oversold and it's going to potentially come back in line, or it's been overbought and it's going to move lower from these highs, or it's moving lower and the signal thinks that it's going to continue, and vice versa. Again, no guarantee of direction, but can help to anticipate a trend or reversal, and it incorporates those moving averages that we already covered. Now, stochastic oscillator is going to be similar to relative strength index that we'll get to in a second, whereby it's bound by 0 and 100, and any given day giving you a value. And you can see the majority of these values between the significant bounds here that are identified by the creator of this stochastic oscillator as being 20 and 80. So when it's between 20 and 80, kind of business as usual, right? Normal, this indicator is deemed to be normal activity and not really a reason to potentially trade. But when it's under 20, it's maybe deemed oversold and maybe has the potential to bounce back or reverse. When it's over 80, the stochastic oscillator essentially saying this is, moved too fast, it's overbought and will likely reverse lower. Again, not a guarantee of anything. But as you can see, a lot of these instances of it being above 80, one, you have to keep in mind that some of these, it was above 80 and the price continued higher and then came lower afterwards. And same with being below 20, can still move lower and then reverse afterwards. But an interesting one nonetheless. Bollinger Band's similar, but kind of more left to your interpretation. They use a moving average, and then they create boundaries around that moving average that are just the standard deviation calculations, which in their own right can widen and converge depending on the volatility of the market. And a lot of people will look for a break in those Bollinger Bands. If it breaks to the upside above a Bollinger Band or to the downside below a Bollinger Band. If I were to be a trend follower, maybe I'd go with that breakout. If I was a contrarian, I would go against that outside movement potentially. And so if it went below a Bollinger Band, maybe buy it. If it went above, maybe sell it. But again, depends on if you're trend follower, contrarian, and if Bollinger Bands line up with your strategy. Relative strength index, similar to that stochastic oscillator, bound by 0 and 100, different sort of calculation, although RSI has become, really popular over the last decade of retail trading on the screen. And you could see rarely has this market in the course of the last several months been above 70 or below 30, but meant to be a signal of, above 70, maybe it's overbought, below 30, maybe it's oversold. And you can kind of line it up and maybe compare. If you like an indicator like this, you can take a look at stochastic oscillator and RSI and maybe compare them and see which you align with better. Fibonacci retracements are mathematical calculations that are based on the Fibonacci sequence that you can apply to your chart. And you can see on that right rail of prices, it points out prices and different probabilities of the market retracing that way lower or retracing ground higher based on historical prices and the Fibonacci sequence here. And a lot of traders will use these to help establish support and resistance lines, depending on where a market is moving. And then we also have the standard deviation here, which, like I said, is kind of baked into the Bollinger Band. It's baked into a lot of volatility-based measures. And when used on its own, it just kind of calculates the variability of historical prices. And so here you have a standard deviation with a 20-unit time window. So the last 20 days, what has been the day-to-day variability of prices? And in the euro dollar market, it's been around 60 pips. And so if volatility is high, the market's really moving, it can be 100 pips, it can be 120 pips. If it's low, it can be 30, 40, 50 pips. And then you can use that range as, okay, so if the standard deviation is 60 pips and the market's 106.80, then an outside movement would be 107.40 or 106.20 to the downside, and base your contrarian or trend following predictions, proclivities, if you will, around that, if you want to go with or against the support and resistance on a day-to-day basis, with or against those breakouts in outside movement, similar to the Bollinger Band. Ichimoku here is a really interesting one. And if you are interested in more high-level indicators, definitely do some added research on this, because there are two lines that form essentially what's called the Ichimoku cloud. And then there are other lines in here that are meant to convey a, potentially upward moving trend or downward moving trend when they cross over with the lines of that cloud. And a lot of similar stuff, standard deviations, moving averages baked into this indicator. But as you can see, it's quite complex and utilizes 5 lines. And if you are looking for that higher level indicator, maybe worth some research here, because to be honest, I don't fully grasp this one. It's relatively new and popular among those higher minded traders. And then finally, client sentiment, another one, obviously, that doesn't necessarily tell you which direction the market is going to move. The market can move in any direction, any given day. But does help to kind of let you know, okay, well, this is where the market is positioned, and this is where clients with positions in the euro dollar market, for example, are positioned long and short. And so you can see 58% long lets you know that 58% of clients with positions in this market are long, 42% of them are short, similar to a commitment of trader report. And again, if you're contrarian, maybe you go against that. If you're a trend follower, maybe you go with it, meant to supplement your ideas.